All right. Good morning, everyone. Welcome back to another episode of the Tim and Tim Show with Making Moves and Multifamily Live. Glad to be back for another fun episode. I think that this one, hell, I think every single one that we do is relevant, and that's how we come up with these ideas. This week, we're talking about creative equity plays and reinvesting your money for long-term gains. It's no secret that the market has been up and down and all over the place, and tax and insurance increases, we talk about it all the time, have really crushed NOI. But if you think about it, it creates an opportunity if you know what you're looking at, or at least if you can frame your mindset correctly. Some people will look at this as a loss. Other people will look at it as fresh opportunity. So we wanted to talk this week about reinvesting your money. There's the saying, one of our good friends and favorite brokers, Chris Yeagle, tells us this all the time. Is he goes, man, I've seen a couple down markets before, and everyone always says, sell your dogs in the down year. And what does that mean, really? It means that if you're not having the outcome that you had expected in your property because of when you bought it and some unforeseen changes that have occurred in your market, if you can sell your dog and take the equity out of the deal and reinvest it into a new deal, why is that a good play? Because a lot of people will be like, I'm going to sell something, I'm going to get out of it, and I'm done with it. I didn't make any money. I'm not going to put any money back into it. But I personally think that that's the complete wrong frame of mind to have, because if you can get out of a deal that you worked really, really hard on and you're going to break even, because unforeseen circumstances have adjusted purchase values and things like that. What you also need to understand is that everyone else that are selling things have price adjusted assets for the same level of change in the market, right? So essentially, you're resetting your cost basis on readjusted pricing that's already taking into consideration the increase in the taxes and insurance that you may not have budgeted for, or that you may not have budgeted for, and that maybe you weren't able to kind of work or navigate around or whatever, right? So it enables you to take your money and say, hey, you know what? We bought it at a bad time. We proved that the business plan was correct, but we bought it at a bad time. And now we're going to take this money, we're going to reposition it into a new asset that has been price adjusted for today's market. And that right there, that resetting of that capital is what will set you up for success. And the people that say that they have never made any money in real estate is because they are the ones that will take the money out and say, I'm done with it. I'm not reinvesting in it. I hadn't made any money in real estate. I'm not going to put myself in that situation again. But it's like, think about it in the stock market. You buy, it goes up, you look, everything's great, and comes back down, and it stays kind of level for a little while. Well, you're at your break even. You can sell it and liquidate your asset, and then you can move it into another thing or leave it in that deal and say, hey, I'm going to reinvest it, and I'm positioning myself for the next run up because I've readjusted my cost basis.
But what if
that's super important?
What about ones where you're not break even?
That's a good question. Ones that you are not break even is, so you have the option, right? You can either take a small loss now, right? Whether that, whatever percentage of that is, let's say less than 25% of your original basis is a loss, right? Is a small loss. A large loss being 50% or more. If you can sell and you get out for less than a 25% loss, I think it's a good idea to do that, because you can take the money and reposition it into a new asset, price adjusted for today's insurance and tax numbers, especially in real estate, right? Or you can say, hey guys, we're going to end up having to put money into this deal because our debt and leverage is very high, and we can survive the next couple of years, but it's not going to pay out anybody any money. We might have to do a capital call to have cash in the bank to withstand kind of future events. And then maybe at the end of 3 years or 4 years or 5 years, or whenever your debt is expiring, you can sell it and break even. So is it better to not take a loss today to break even 3 years from now? Or is it better to take a loss today, reposition, put your money into a new price adjusted asset, so that you can set yourself up for success, so that when the market does come back up in 5 years, that you are positioned to sell it for profit instead of sell it for break even?
Yeah, because guys, like using the stock market example, um, the guys sell for losses in the stock market all the time. In fact, there's whole tools set up for that, right? I mean, it's called uh, harvesting your losses, right? So
Yeah. I've heard that more commonly used in the stock market. I truthfully, full disclosure, I
well,
don't really understand that whole harvesting losses thing. Man, can you explain it a little bit?
yeah, it's the same thing that we've talked about in the real estate world, where you take a loss and you redeploy that equity. You take the loss on your K1, you're going to show a loss. So you're going to have a tax write-off at the sale of the property. And
Yep.
then you're going to take your profits and your cash that you actually got, because let's hope you didn't lose everything, and you're going to redeploy that into another asset. So you got the tax write-off on the loss. And as you've already talked about for the first few minutes here, you redeployed it to an asset that in 3 years, over the same period of time that you think you're going to get back to even over here, you're actually in the money 3 years from now rather than at par.
At
So
par, yeah.
so today you took the loss, you harvested the loss, you took the tax benefit from the loss, you redeployed that equity into another deal. In 3 years from now, you're above par and so you kind of double dip there.
Mm,
And that's where it's kind of where I tell people all the time. Like I've had guys, I've had partners that look at me and they're like, I don't lose. I don't lose. And it's like, maybe not on paper, but you lost, right? Like, because like Tim's basically saying here is you may hold and you may get back to even, but what did you miss in the
mm,
down cycle that you could have deployed into that would put you ahead of where you are 3 years later,
yeah.
right? So I've seen some deals like that, right? Where you hold on for dear life. You're like, I refuse to take a loss. I refuse to take a loss. Can't handle it. Right. Well, then 3 years down the road, you're like, man, I'm back to where I was. But damn, if I would have bought this thing over here in the down cycle, my cost basis would be 50% lower than where I'm at on the one I still own. And I'd be well ahead of where I am. Right.
Hmm.
um, and I think people miss that, right? Because in the ideal world, what you do is that's coming, and you go sell for break even or even a slight profit because you see it's coming, and you hold on to that cash, and then you redeploy it in the down market, right? Um,
Mm,
that's
yeah.
the ideal scenario. You sell
Yeah,
high,
yeah, but,
buy
what do
low.
they say about timing the market, right?
But guys, like Vitali's talking about here, it's like, hey, if you do enough deals, you're going to have some dogs, right?
Yeah,
I mean,
yeah. It doesn't matter what you invest in, if it's
no,
real estate, stocks, bonds, notes, you are gonna lose money eventually. Not every deal is a winner.
no.
Not every stock is a winner. I mean, I finally bit the bullet and I've invested in some stocks, and a couple that I thought were going to do great are still kind of flat and doing nothing, and some that I thought were not going to do anything are my best assets. And I was like, damn it, I wish I doubled down on that one instead. The same is true in real estate, right? I mean, things
Yeah.
change, business plans change, the economy changes, tenant base changes, property management changes, um, asset condition changes. I mean, everything changes over time, and understanding that, hey, it is what it um, is sometimes it's a tough pill to swallow, right? Especially you have that mindset of, hey, I don't lose money. Well, okay, well, you can, I also argue here and say that the people that aren't willing to sell and take a loss are also the ones that aren't as actively engaged as we are. Like a smaller mom and pop investor might just, that old school mentality of I'm just going to own it forever through the ups and the downs, right? And
which is
that's fine.
which
You'll
is
make
fine.
money
Yeah,
in time, 5,
right.
10, 20 years, you'll be laughing about it. But if you're trying to make money now, kind of being a bit more proactive about it and understanding market economics and market cycles and all that kind of stuff is important to ensure that you're paying attention to the best place your money can be placed. And it all comes back to an IRR basis, right? It's how fast can you turn the money around and make money with it? If you own something for 20 years and then break even, your IRR looks real bad,
Yeah.
right? But you didn't lose any money, which, what's more important to you, a great IRR or not losing any money?
Yeah, and that's a really good example. It's sometimes I like those extreme examples to kind of to
To
kind of
bring you right, bring
to kind of get your
perspective.
head, yeah, to get your head in the right place, right? Like
Yeah.
it's kind of like the other side where folks are like, oh, I don't buy four caps, right? And I'm like, well, would you not buy for $1? Would you not buy a completely vacant property that you could throw $1 million in and have a $5 million property? Because at that point, that's a zero cap, right? So
Right. Yeah.
I'm
No, I
like,
won't pay that.
no, I'm not going to do that.
Oh, but that one I will, of course.
So, I'm always like, hey, let's use some extreme examples. That's a really good example, Tim. It's like you don't lose. So you're going to hold for 20 years. If it took you 20 years to get to break even, you're not willing to take a loss, right?
Yeah.
As opposed to, hey, what if you took a 25% loss and you had 750 grand of your money or investor money, and with that money you could go over here, and because of the way the market is, you could buy something for $40,000 a door, right? That 2 years ago sold for 70,
Yeah.
right? And
All
it's like,
day. Just sit on it.
yeah, yeah. Would you do that? I would.
Absolutely.
I 100% would. Right.
Yeah.
And that's the kind of stuff we're seeing in this market right now. I mean, we're seeing things where people are, it's like not just break even, folks. I mean, we're seeing, Tim and I saw a portfolio where guys they paid 200 a door like 3 years
Over.
ago,
Over 200 a door.
over 200 a door. It's going for sub 100 a door right now.
Mm.
Right. It's like, guys, like these opportunities are out there, but don't take a loss.
And in that example, I wouldn't say that if you sat on it, you'd be able to get $200,000 a door for it
No,
again.
no, 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 no.
But you can reasonably assume that you can get 150. So if you bought it for
Sure.
100 and you sat on it and did nothing, and you sold it for 150 in 5 years, you look like a genius.
Yeah. I mean, there are deals out there like that right now where you can go get them at a 30, 40, 50% discount and really not do anything. Just
Yeah.
just
My
ride it.
favorite is these brokers that continue to follow up. They're like, oh gosh, they said they'd be interested in selling at their price. And I was like, well, I just can't get to their price so that they don't lose money. And I asked them, are they interested in, a little bit of seller carry to help me bridge the difference there? And they're like, no, we're not interested in that either. So I was like, okay, so they want their price. They don't want to lose any money. And they're not interested in seller carry. They know they overpaid. What do you want me to do about it? And ultimately the conversation was, I don't really think that they're that motivated to sell it. And he goes,
Yeah.
no, they are motivated to sell it at their number. I was like, everybody is.
You and I are using motivated to sell differently. We're saying the
Yes.
same thing, but we're using it differently.
You're using the same words, but we're
Yeah.
not speaking the same English.
Yeah. Yeah. That's all, and Tim, it's like that, right? And then I also like the other one, which was hey, guidance is 20 million. And I'm like, well, my offer is 19. Well, guidance is 20. And I'm
Okay.
like, okay, I'm out. And then they come back and they go, but are you still in at 19? And you're like,
Did you miss my last message? What about the out part? Didn't you understand?
yeah. So I always enjoy those games. Yeah.
Yeah. Well,
But
it's just interesting, being on both sides of the table right now feels really good to buy stuff. Let me
it
tell you.
does. It does.
You really put the screws to some people, and let me tell you, we are getting some deals right now coming across our table, and it feels good. But if you got to get out of something, do you understand the words coming out of my mouth?
Rush
Um,
hour reference.
yeah. Blackie Chan. um, Yeah, man, it's an interesting time to be in the investment market, but it is also interesting to see who's sticking around and who's not. And I can tell you, like the people that have been in this for a long, long, long time, we've had some conversations about ups and down markets, and they always say, "Now's when they make their money. Now's when they make their money." The people that we're talking about that sell because they didn't make any money. Well, it happens in the stock market, it happens in real estate, and they're like, "We're buy these things for pennies on the dollar." And then we're just patient and we sit on it, and that's how we make money in real estate. And
Yeah.
I'm actually really, let me express a little bit of gratitude. I'm grateful, and I'm also thankful to see how the market was in 2019, 20, 21, 22, how it's been in 23, 22, 23, 24, and into 25, because now I know that when we're buying these assets in 2025, 2026, that these are the ones that we're going to sell in the low 2030s, 2035, something like that, right? 10 years from now. And it's going to be like, oh my God, I'm so glad I bought everything right now. But it
Yeah.
also let me see, okay, now's the time to get out. And then I'm going to put all my money in a high yield savings account. I'm just going to sit on it. And I'm going to wait 2, 3, 4 years. Things are going to come crashing down. There's going to be another black swan event. And then I'm going to load up again and buy everything that I can. Right. Because it's really given me the perspective of the up and the down market, what metrics to pay attention to, how to underwrite differently for each market cycle. Things that I didn't pay as much attention to now, I understand why some people pay more attention to them
Yeah.
than others. And it's not to say that there's the difference between a good investor and a bad investor. It's just what experiences have you had? What have you learned? And what hard lessons have you learned that have changed your mindset and your perspective? And you can tell by the questions that you ask. And I'm just grateful and I'm thankful to be able to go through this and understand the difference so that when this happens again, it will be like, I can see my exits coming up a mile in advance, time to get in the right hand lane.
Yeah. Tim, you're talking about that. And so I was doing some stuff in '09, 10, 11. And I remember sitting there at that time wishing I could be the guy on the other side. Like
Yeah.
I was in a bad position at that time. And I wanted to be the guy on the other side because, I remember sitting there and people are like, why would you buy real estate right now? Why would you buy real estate? Why would you buy real estate? And I see these guys that are scooping things up, 60, and these are single families, guys. 60, 70, $100,000 less than was paid for them just a year before.
Yeah.
Literally, that's what things were like then. And there, I'm sitting here going, if I could, I would be buying everything I could possibly get my hands on.
Hmm.
And man, let me tell you, the guys that did that, just 2019, 2020 rolls around, they just
Sold everything.
absolutely, dude, they
Yep.
absolutely crushed it.
Yep.
Absolutely
And now they're
crushed it.
all buying again.
Yeah. And they, those guys, those were the guys that were kind of like, I had 10 years of run there. I'm going to go take a little trip and I'm going to see you in a couple of years.
Yeah. Right. Right. And I remember like thinking about it, I was like, man, everything's so good right now and debt's so cheap. Like why? And they've just seen it before,
Yeah.
and I'm just grateful. And I'm thankful to be able to go through this and understand the difference now. Because even like, so we're building a primary residence. And one of the questions I asked the builder is she didn't really pay a whole lot of attention to comps. She's like, well,
Mhm.
this one's for sale and this one's for sale. And I said, that doesn't matter to me. What are the sold comps? What's the price per square foot on a sold comp? And show me how we take the lender out because we got to get a construction loan, right? And I said, show me how we take the lender out because I cannot be in a position where we can't take out the lender because you want to build this house the way that you want to build it. And I said, my primary concern right now is how do we get this lender out so that I don't end up in a bad spot? And she's like, no, that's something we got to pay a little bit more attention to. And I was like, trust me, I know.
Yeah. So, I mean, but guys, like, listen, seriously. And what was interesting, yeah, this is one of those markets, right? I've seen a lot of the greedy and fearful Warren Buffett memes going around, especially right now, especially in the last few weeks, which is
Really?
interesting to me.
Hmm.
Oh yeah, I've seen a ton of
I
it.
haven't really
Um,
noticed. I mean, I did delete Facebook and Instagram from my phone, so I don't see a whole lot of that stuff anymore. Only when I purposefully log in on my computer do I see that kind of stuff, but I don't spend a whole lot of time scrolling anymore.
yeah, no, most of this is on LinkedIn that I'm seeing it. So, but
Ah,
either way, like you're seeing a lot of it right now, and it's not wrong, right? Like this is you're seeing a lot of people fearful sitting on the sidelines, and because there's a couple guys out there that are like, hey man, this is greedy time. This is
yeah.
time to get greedy, and I completely agree with them. But what I thought was interesting is you had been seeing articles, you had been seeing reports, people track Berkshire Hathaway's movements,
Yeah.
and 6 months to a year ago, Berkshire Hathaway was moving into cash positions. They were getting ready, getting into cash positions. And people are like, what are they doing? What's going on? What are they planning for? Well, here it is, folks.
Yep.
Like, but that dude and that company has been around so long. They've been through so many cycles. They started to recognize those little indicators, right? Of, hey, this is coming. I'm seeing this. I've seen this before. I don't know exactly when it's going to happen, but I'm preparing for it. And now they're in this like huge cash position, and now they're just gobbling stuff up. And in fact, if you watch them, as far as the stock market goes, they're kind of saying we don't think we're there yet because they really haven't deployed heavily.
Yeah.
So as far
Yeah,
as
they're
the
kind
stock,
of they're kind of like dollar cost averaging right now. I think if we're not at the bottom, we're close. So let me just pick up a little bit here, and a couple months I'll pick
yeah,
up a little bit more.
they if you watch what they're doing, they think we definitely have a bigger drop coming. So we'll see, and we'll see if they're right. They're not always right, but the one thing I can tell you from the real estate piece is like, I don't know, man. I see some stuff that is similar to '08 and '09. This is not '08 and '09, so don't anybody go out there and say I said it was, because it's not. But I see some similarities, and I'm like, I want to buy.
Yeah.
I want to buy right now. Because I'm going to be very happy 3, 4, 5, 10 years from now that I bought right now.
Oh, absolutely. Yeah. I mean, there's, then, we just recently had a conversation. What was it, yesterday? Maybe maybe yesterday. We're talking about, well, these are the types of things, Tim, that we buy and we sit on for 10 years. We don't really raise the rents. Maybe you go up $25,
Right.
$30 a year. You don't piss off any of the residents. You keep it full, keep everybody happy. You don't really have to do this huge value add plan in order to push the equity valuation up. I mean, because it will go up naturally in time as the market comes back up. And being in that type of position where you're more than covering your debt and you got significant
Yeah.
amount of cash flow is incredible feeling. Because I mean, that one property that we have, Tim, whenever something breaks, okay, fix it.
Yeah.
Fix it. The money's there,
It's
fix it.
guys, I don't get me wrong. Like I'll always do some value add plays. I'm too much of a junkie not to.
Yeah.
But Vitali's right. Like every now and then you come across that one and you look at that mom and pop or those two partners that have had it forever, and it's like, man, their rents are $700. They could be getting 1,100, right?
Yeah.
And then you look
Right.
at their P&L and you're like, holy crap, look at that partner distribution every month. Like,
Yeah. Right. Yeah. You're
and
like,
you're like,
oh, that's nice.
it's paying its expenses, it's paying its mortgage, and look, these guys are taking this every month.
Yeah.
And, and
Yeah.
you're
Now
like,
there is an argument to be had. I mean, if we had something, I wouldn't be $700 or $500 below market rate rents.
no,
Those are the people that really don't raise the rents at all. I mean, but we have a setting in our property management system where it just automatically will increase the rent by 3, 4, 5%, whatever you can put a dollar
yeah,
amount in there and just say, hey, on renewal, no matter what, going up $30, just so that you don't find yourself that far behind market.
yeah.
And you're training your residents to know, like, hey, things go up. Now, you could find yourself in hot water, though, because we had all those ridiculous insurance increases over the last 2,
Right.
3 years. And
Right.
then you have to raise the rents, right? That's
Yep.
also kind of an equity. That causes a lot of people to have an equity event because they don't have the CapEx reserves to do the renovations, because you increase the rent by $300, $400, $500 on somebody, they're probably going to leave. Then you got to
And
renovate the
yeah,
unit, and you might not have $10,000 a unit to renovate all these.
yeah, because guys, more than once, believe me, we've had renewals where we're like, hey, we're taking you up $250, and they're like, you want me to pay 250 more next month for the same place I'm living in right now?
Yeah. Right.
And I will tell you, as a property owner, you're kind of like, that's actually not an unreasonable comment.
Yeah.
And
Right.
and we could all be like, well, where else you gonna go?
Yeah.
But hey,
Well,
I mean,
especially in the affordable space, right? Because, like, hey, it's
yeah.
a 2-bedroom, 60% unit. You're going to pay this everywhere.
Yeah. Now the other piece of that is like, at some point you also do want happy tenants because they make your life a little bit easier. So there's some give and take there, but I digress. But guys, like, seriously, this is a really good time. And what I would tell you is Tim and I have had conversations with investors where we have said, hey, we have an opportunity here to sell. We've had an offer. It's not a great offer. But what would you like to do? It's on the table. We can hold it. We can ride it out, whatever you want us to do. But let's talk about what you, the investor, want to do. And the investors will ask a few questions. And if it gets down to, hey, it's going to be a while. We're going to have to ride this out. We may get back to even on 2 years from now, 3 years from now. Most of the investors we've talked to have been like, no, man, let's sell and redeploy.
Yeah. Just give me my money back now and let's redeploy into something else.
Yeah. Where do you think we'll,
answer.
if we sell and redeploy, where do you think we'll be? And when we can kind of give them some light guidance towards that, they're like, well, then yeah, I want to do that, right?
Yeah, right.
So, I just would encourage you guys, like, don't. It's not all about. It's not all about the dollars on the sheet, right? There's opportunity cost. There's brain damage. There's all these other things. It's like, what can you do with the money you have available today, and where will you be 3 years from now if you do it, right?
I think honestly, Tim, what we're kind of touching on is it's really risk management, right? I
Yeah,
think in terms of risk management, it's more risky to stay in a deal that is suffering with increased expenses, right? I think it's more risky to stay in a deal like that because you don't know where the top is. The expenses could keep going up. And if your rents aren't going up
right.
at the same pace, then if you look at the writing on the wall, you might not see a path to be able to replace the debt. You might not see a path to be able to pay the expenses. And it's like, okay, well, I see the writing on the wall. Let's make a decision now so that we can protect the downside, right?
Yeah,
Ultimately, that's what you want to make sure that you're doing is protecting your ultimate downside. Because the worst thing that could happen is you have to give the keys back, right? I mean, that's a really bad scenario, right? I mean,
that's a bad scenario. Yeah,
that's a very bad scenario. But the also it's a difficult conversation no matter which way you look at it. Say, hey, we're going to sell for break even or a small loss, or hey, I actually need to do a capital call, and then you're going to get upset that we're doing a capital call on a deal that's not paying a distribution. So pick your poison. I'd rather
yeah,
have the conversation once.
yeah.
And
By the way,
ultimately, at the end of the day, it's important to make sure you're protecting the downside.
yeah. But by the way, just one little piece here, and just a little food for thought for you guys. Um, Real life scenario just happened about 2 weeks ago. Guy I know pretty well. They were invested in a deal. They were running a deal. Was in horrible shape. Horrible shape. Through a lot of factors that they could not control. 6 months ago, they were literally talking about, I think we got to call the bank and tell them we can't do it. Turn in the keys, right?
Mm.
But they kept pushing forward. They kept trying. They kept trying. They kept trying. They ended up getting a deal that ended up being, I think, a 12% loss.
Oh, what a
They
difference.
didn't turn in the keys. They got their investors about 85 to 88% of their money back. And all but one investor literally called these guys. They were like, man, thank you for keeping trying, right?
Yeah.
And most of them said, what do you got coming? Like, where can I
Yeah.
redeploy? And I always think it's funny. He's like, but there was that one guy. He's like, I really think we should have held out for more.
Always one.
And he's like, dude, he's like, man, we were literally went from handing in the keys to giving you almost all your money back.
Yeah.
We went from 100% loss to a 12% loss. We're not holding out for more.
No. I'll take this would be considered a win in my book.
Oh yeah, for sure.
Yeah.
So,
So obviously, redeploying, in terms, in deals like today and how things are kind of moving around. Ultimately, the best way to measure that is to pay attention to your equity returns. I tell people this all the time, but making sure you pay attention to your return on equity. Cash flow isn't the only metric that you should be paying attention to. If your return on equity is sub 7%, it's time to redeploy, whatever that looks like, and put that into something that can make more money. Because I mean, hell, you can put the money into a high yield savings account and make 4.5% with zero risk, right? So pay attention to your equity returns and look at your options that you have on the table, whether you can do a cash out refi, if you can do a 1031, if you can just liquidate the asset and move it into another opportunity. But the big thing is you got to be involved in the market. You have to have opportunities on the table. You have to be assessing the risk and assessing the returns all the time, paying attention to the debt, talking with the debt brokers and seeing what options are out there, because everything's changing and moving all the time. So just keep a good thumb on your deals. I mean, really, at the end of the day, it's good asset management, just paying attention to the deals and paying attention to your money and how it's performing for you. So,
yeah.
All right, guys. Well, thanks for joining. Appreciate you joining. And hope you learned a little something today and are paying attention to your deals and considering if you need to dump your dogs or if you're going to hold out and see better days on the horizon. So thanks for joining, and we'll see you again next week.
All right, see you guys.